Welcome to The Educated Trader. I'm Dr. Alex Mosley, and in this short course I'm taking you through the very basics of trading principles. This is the second tutorial in which we'll be going through the basic market types: the bull market, the bear market, and the sideways, or what I like to call the penguin market. This is what we call a trending market, and specifically a bull trending market, or going long. It has an obvious upward movement across the time period. Most of the candles are green, and there are a few of what we call pullbacks, which can be seen with the red candles. Generally, we also see a bull trend as enjoying a series of higher highs and higher lows, though there can be aberrations during minor sideways movements, such as the one highlighted there. Now, by the way, it does not matter which time frame we are looking at here, because this could be on the 1 minute chart, or the daily, or even the monthly. What we need to recognise is that a trend has been taking place over a period of time. At this stage, we do not know anything about the context in which this happens, and that later may become important to us in how we become a trader, because we're not given any information as to what the market did prior to this or afterwards. Now, here is a downward moving market, also called the bear market, or a market going short. It is trending from high prices on the left-hand side of the chart to the low prices at the right-hand side of the chart. Again, most of the candles shown in the chart are red or bear candles, and the market is moving on a relatively diagonal line. There are some mild pullbacks in this example, and we can point out another general characteristic of the bear market, that is, a series of lower lows in price, but also of lower highs. Now let's look at the next type of market. The third type of market is one in which the price ranges between two boundaries. This can also be described as going sideways, ranging, or consolidating. Now, for fun, I prefer to call it the penguin market, huddling around a defined territory, not really sure whether to break out of the flock and go fishing. We can identify it historically as trading within a box which can be drawn, with the upper and lower limits identifying the high and the low prices during the consolidation. If we draw a line through the middle of the consolidation, we can see that the price fluctuates around a central price or an equilibrium, however we want to describe it. It does not get far from either being too high or too low from it. Now, such periods of consolidation can last a short period, or many days, or even weeks or months. Again, this is what we're looking at, a historical review of what markets can do. Consolidation periods can be relatively wide or narrow, and that again can affect whether we would wish to trade them within the box or wait till the market breaks out or moves out of that box. Here's a market consolidation that suggests it's gone to sleep for about 22 periods. There's not much going on here, but let me give a little bit of context for this one. The vertical line that you can see on my chart, which I can highlight, indicates the end of the trading day from the UK perspective. The main British and European markets have closed, and US markets have wound down for the evening. The Forex markets continue to tick over as the Australian and Asian markets slowly begin to open up. Now, few institutions are trading at this stage, and in the absence of dramatic news, there's little volume to move the market one way or the other. Now, a quick recap of what we've been looking at. These are the three market types: the bull, the bear, and the sideways. Our goal as a trader is then to consider how we may make money in these different market conditions. That is what building a system, and particularly the strategy, is all about, and something I offer in a separate course. Next, we'll look at discovering the bull, the bear, and the consolidating markets historically in the context of broader market moves. Let's start with a relatively simple review before we dig in a bit. This is an example of 3 years of the DAX, the German Equity Index. At first glance, we can identify a broadly bull market rising up through 2016 and completing its move towards the end of 2017. Around the month of January 2018, it turns into a bear market, and in the end of that year, it is lower than it was at the beginning. Now, on second look, we can see that the upward and downward movements are not without their jagged periods, when the market presents volatile periods for several weeks at a time. Here's one, here's another, third, and a fourth. We can see that there are occasions when the bull market seriously looked as if it was going to reverse its trend. There, 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 and there. And once, when the market was emerging into the bear trend, it seemed to return to a more bullish momentum for a period. Now, you may see things on this chart that I miss, and vice versa. That's okay. We often miss patterns within patterns or the elephants in the room. On a third review, we can pay more attention to those sideways or ranging markets. They are very important to understand because they tell us that markets are not always in bull or bear phases. And if we're going to trade, we'll need to know how to handle them. They can be very frustrating to be in if we don't have some tools to help guide our decisions or experience to see us through them. And that can be very costly to our equity. The first box presents a very volatile period lasting from March through to August 2016, a period that included the famous Brexit vote in the UK. The lines on the box seek to capture the upper and the lower limits of price, though we can see that there was a breach to the short in late June. The upper limits are then broken and we move on to a new sideways or ranging period for the late summer, and into December before the market gains an upward momentum. But again, there is a bear attempt to push the market short, but that is overwhelmed in a day. Before the market proceeds with its bull trend. There are two relatively less volatile periods, sideways periods, that occur mid-2017. And these are followed by two more ranging periods that present greater or raised volatility. Now, the next two periods that I'll highlight are quite interesting. The first presents an M shape, or what is known as a double top. This can herald a reversal, and which does here play out. So we may discount it as a sideways movement, since while there are only two touches on the upper bound, there is only one on the lower bound before it breaks. The second one, similarly, presents a 2-to-1 touch ratio, but inverted, and this appears as a W shape or a double bottom. Now this can sometimes indicate a reversal, which in this case would have been a reversal to the bull, but here it does not materialize and the market continues its bear trend. Now, when we are bounded by a high and a low, which the traders are respecting for a period, we do not know how long that period will last, and thinking about how to play that to create some rules and strategies is going to be very, very important for us. Now let's drop down a time frame and review the same sort of moves there. This is the DAX on the 1 hour time frame over a period from mid-December through to the beginning of February 2018. Now let's see if we can spot the trends and the range of moves. Firstly, the bull period should be identified as either emanating from a breakout from a ranging period or as a sharp reversal. Now press pause for a second and see if you can identify the bull trends. Okay, here are the bull trends that I see. Now we don't have to be completely right on this game, we just want to get an idea of what's happening. Now pause the video and assess whether you can see the bear moves. Here are the bear moves that I see that jump out to my eye. Now let's look a bit at some of the mini trends that appear. They can be what can be called counter trends, which attempt a reversal from what we later see as an overall upward or downward trend. There's one. There's one there. Another one. And a fourth there. Now 3 of these, A, B and C, present sharpish single moves upward. There's a tiny break with B, but you can see that it's almost done in one move, rather than a zigzagging trending market with higher highs, higher lows. Now that can be seen with D, which offers a better example of a higher high breaking through here. So can you see, see if that comes through. Higher high, high, low, and then moving up. So there's a slight zigzag there. Now, when thinking of a system, we may need to consider how to deal with moves such as A, B, and C, and ask whether something like D presents a justification for exiting the bear trend. Now, with hindsight, we might think, why would I want to exit at B when that trend had a long way to go? Because when we're engaged in the trading, in the counter move that becomes D, we don't know that it's going to reverse again and continue the bear trend. We need rules to help guide us through such moves, whether we exit at a certain point or whether we hang on for some identifiable rule that we can create. Now for the sideways or ranging, the penguin markets. Let's pause the video and see if you can spot any. Okay, I'm going to bring out 6 here. There's the 3rd, 4th, 5th and 6th. Now some of these, A, B and C, may not seem important, but they do last at least a day. They also do not show much of a width of volatility compared to the other 3, D, E and F. But all of them are bounded by a high price and a low price, which they generally respect for a period. So in this video we have reviewed how to identify the major market types, the bull, the bear and the sideways markets. The next tutorial will go into reviewing how we may be able to spot the beginnings of the bull, the bear and the sideways markets, which we may find very, very useful for any strategy that we wish to create. Thank you for listening and watching. I'm Dr. Alex Mosley. Cheers.